paratroops are landing. They're landing all around me as I speak. They've come in from the sea, and they're fluttering down, and they're just about the best thing that we've seen for a good many hours. They're showering in. There's no other word for
it. D-Day, the longest day, represents the turning point of World War II and marked the initial invasion of the Allied forces of Western Europe and the eventual defeat of Germany. The cost of war is steep, and D-Day was no different. 10,000 Allied soldiers were lost in the battle, a number of U.S. soldiers buried in the Normandy American Cemetery overlooking Omaha Beach. In honor of the 70th anniversary, SD Bullion is privileged to launch D-Day, the first coin of the Heroes SD War Collection in limited mintage. Heroes, don't let them die in vain. Start your Heroes SD War Collection today, only at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us today is our good friend Harvey Organ from Harvey Organ's Gold and Silver Reports. Great to have you back, Harvey.
Well, thank you for having me, guys. How's everything at your end?
Well, we keep chugging along here, as well as does the capping of gold and silver here. We're recording the show this week a day early on Thursday evening, and once again, after being capped really between 1290 and 1300 all week thus far, gold opened the day with a strong move through 1300 and then was promptly slammed back through the level and back under towards 1295, where it consolidated throughout the rest of the day. And same thing in silver, a big move up towards the top of its recent pennant, getting close to $20 and then slammed right back down to $19.50. So what's your take, Harvey, on the trading this week in the metals?
Well, you're actually seeing a contraction in the levels of gold trading, where the low being 1282, as you mentioned, will probably be the low, and 1300 the upper level. And it's going to stay that way for quite a while. And the reason is of course, that anything below 1282, our friends from China and Russia will take anything you got. And at 1300, the banks can continually supply massive paper. They are going to have a massive derivative problem. And you can see by the contraction, as more of the physical metal starts going into China, you're leaving a huge obligations, probably anywhere 100, 120 obligations per 1 ounce. And that big bubble is now starting to hurt our bankers. And that's why you're seeing a narrowing of the trading range in silver and gold. And eventually it'll burst and the banks will default. And that's what I'm seeing. It should happen very shortly. So
you're looking for a derivatives crisis to happen shortly related to gold price then, Harvey?
It could be both. It could be both metals. Let's talk first about gold. I'm seeing two things excite me. Number one is I'm seeing Shanghai brings in roughly 4 tons a day, and that is a delivery exit out of Shanghai Gold Exchange. That's per day on a 7-day week. That's huge, and the demand for these guys have not stopped. But what excites me is the levels of importation from England has slowed dramatically in the last 5 months. And the reason is because England is running low. And we're seeing that on the GOFO, negative GOFO rates. And as it actually was 29 out of the last 30 days, it was negative, which means the London good delivery bars are non-existent. So I was excited to see that, and was also excited to see high exports of the gold from the United States. And the interesting thing, of course, they don't have it, so they're actually stealing from the Federal Reserve Bank of New York, which is gold belonging to sovereign foreign nations. And that gold is now supplying China, making up for the loss of England. So I'm seeing that, and that kind of tells me that we're coming near the end. If I start seeing if we start going back into negative territory on the GOFO rates, I'll be quite excited, because it tried to exit the last 2 days. Obviously, a small amount of gold got in, but it turned a bit negative today. And if I can see tomorrow, or as they come in for June delivery, see, because June is a huge delivery month, second biggest delivery month on the COMEX. And if I start seeing it going negative again, that'll excite me a lot. As silver, of course, there is no official silver anywhere. And but it's when I start seeing huge premiums over in Shanghai, and for demand is just going off the roof of everybody. Then it's demand. I mean, you can see, in Canada, the mints are running full tilt producing silver, and I'm seeing the same in the United States.
And Canada's on pace to shatter their all-time sales record for the silver maple this year.
Well, yeah. See, I don't know if you guys know, the United States produces about 33 million ounces a year, and all the demand is already, I think, coming to about 44 million ounces, 45, maybe even higher. The demand is really so. In other words, they got to get it from somewhere. They're not getting it from Canada, because every ounce that Canada produces goes to its mints and its jewelers. So the only supply that they really can get it from is Mexico, and they're running dry. Okay, so you can imagine how tough that's going to be. So silver is another issue. You got both metals. And
one other thing I want to add, Harvey, just for a little commentary or color, that 40 to 45 million number that you just threw out there, that is actually just the U.S. Mint Silver Eagle sales. And just from our perspective, from what we see, so as a retail seller of silver in the U.S. with SD Bullion, I mean, Silver Eagle sales are probably, at least for us, maybe 25%, 20 to 25% of total silver sales. It doesn't count silver bars, silver rounds, all of the private mint stuff, which, at least what we see, is actually higher volume combined than the Silver Eagles are.
Yeah, not only that, is the demand for silver for uses in pharmaceuticals, in solar power, solar energy, in flat screens. The demand is huge. You're looking at a demand somewhere around 900 million gold, 900 million ounces. The world produces 700 million. Okay, and then you got scrap coming in, so you have a deficit of 200 million. And then you got, on top of that, the hoarding of everybody. I mean, look what happened in India. I mean, the stupid doorknobs go and put a tax. They put a tax both on silver and gold, but the trouble was silver is so cheap and so underpriced that the citizens went to silver. And they imported 25% of the global world production in India. So that really set the deficits for silver on its ear, and that's why you're going to have your crisis now. So the boys, the banking boys, are going to have real trouble. And my theory is that it was the Chinese who loaned the United States silver. They needed they needed that to go along with the gold suppression. So there had to be a nation, somebody had to supply 300 million. The only nation on earth that had official reserves was China, and I think that they lent that, and now China wants its silver back. So you can imagine the mess. So they are probably having fun at the COMEX, and that's probably why you're seeing the open interest more on the silver side higher than the gold. The gold OI is on the low side, but silver OI, open interest, OI's open interest, is on the higher side. And I actually believe that the Chinese are very instrumental in that, and they're trying desperately to get some of their silver back, which they lent the United States.
And speaking of China, we'd be remiss if we didn't discuss really the story of the week of Russia and China's gas deal. It's being called the deal of the century. Jim Willey is coming out and stated that this alliance will destroy the U.S. dollar. What's your take, Eric, on this week's deal between Russia and China that's been really over a decade in the making?
Well, that's actually a really important point. It didn't come out of nowhere. Some of the press is suggesting that this is something that's a kind of a surprise or whatever. Gazprom and Russia and China have been talking for quite some time. This is a very big deal. They're talking about it as being valued at about $400 billion worth of trade over the life of the pipeline construction project and the flow, the 30-plus years time frame and whatnot. So it's a big deal for Gazprom and for the denomination of energy trading outside of the dollar zone. And we have been seeing just a kind of perpetual chipping away of the dollar's reserve status and trade status dominance in the global system. And earlier this year, we were easily at 25% of global trade being denominated outside of dollar-based transactions. And at the rate things are speeding up, I mean, we're going to see, maybe another 10 percentage points or something like that, maybe even possible by 2015, 2016, which is, to wrap one's brain around those kind of numbers, suffice it to say it's well in excess of what anyone may have imagined 5 years ago. So this whole game plan has been speeding up. And you layer on top of all of that the geopolitical garbage that's going on, brinksmanship and whatnot, and it's putting pressure for both China and Russia to further their bilateral relationships. So this kind of stuff is going to accelerate going into the summer. And with the state of global inventories that can be pilfered to source gold and silver to meet the exploding demand being as it is, that this summer could very well be the time frame where after all of these years of saying at some point we will probably see COMEX defaults and just a fracturing of the system as early as maybe this summer. June, July, August, September, that time frame could easily bring something like that happening. We hear constantly in the press about how investment demand for gold and silver is down, and we've heard a lot of garbage in the last month or so talking about how there's been a tapering, to borrow Janet Yellen's favorite words, in gold demand in China and whatnot, and it's total nonsense. The level of propaganda that's going on is commensurate to the amount of stress that's in the system, and the powers that be are really scared about what's going on. And I think for good reason, because there's a lot of fracture lines that we can see already, and demand remains high. We were talking about silver a moment ago, and the total investment demand in terms of hundreds of millions of ounces for silver, in the grand scheme of things, when you translate that into a dollar value and compare that to financial assets worldwide, the paper versus the real stuff, in terms of silver, the comparison is really small. I mean, silver is minuscule compared to what sloshes around daily in the Forex market, for example. So we already see the increasing interest in Western buyers for investment demand in silver, and that's pretty exciting because Canada has now record sales of their Maple Leaf program, and the United States Mint is cranking along, and there's just, at some point, all of this has got to give. The powers that be are still able to push things around with paper, but at some point, again, it's got to give, and we'll see a managed retreat with the prices moving a lot higher. Who knows? Maybe it'll take $32 silver or so by the end of this year just to keep things under wraps with their paper game, if they can, maintain that illusion going forward. But I think we're going to see a lot higher prices. 50% plus moves in silver to 20, 30% in gold or so in a matter of 6 months.
I really think you're going to see a price of, you're going to see gold, what you're going to go to sleep on Thursday night, let's say gold is at 1,400, 1,300, and on Friday morning they're going to say gold's at 3,000 to 4,000 bid, no offer. That's when they're...
Well, if you see that kind of, that implies kind of like a force majeure contract settlement on COMEX, and then prices being liberated thereafter, and I'm not so sure we're going to see that full explosion unless if it's tied with some kind of a banking holiday.
Well, I think you're going to see, here's what I think you're going to see. I think you're going to see China and Russia, who are both joined at the hip, are going to, they are basically, every day, they're going to want their gold. And it's going to go overseas, and no matter what. And if the United States can no longer supply that last ounce of gold, the game would be over. They're not going to, you know, China's not going to give up its goods, and until they will probably then announce how much reserves they have. I think China probably has maybe 5,000 tons. They certainly have more than the 1,054 tons to their credit. So I think the moment they announce 5,000 tons, and Russia will probably announce they got maybe a little more than what they're showing. Maybe not, I don't know. But together, it's going to realize that, wait a minute, the United States doesn't have the gold that they do. You'll probably then see gold skyrocketing and be nobody selling it. So that is what I see can happen. And then you'll see a run on the COMEX. And of course, they'll default, and that should start the game. That's when the fun begins. And it's not going to be pretty. It's not going to, you know, the whole paper default system is going to be, I mean, you're probably looking at 1.3, 1.4 quadrillion US dollars worth of derivatives that are going to burst. And that's going to hurt everywhere.
That would be a Great Depression kind of scenario if we had a deflationary crash in the derivatives market with that full-blown implosion. I mean, the scenario you paint is definitely possible. The one thing that I think about when it comes to China and its relationships with the United States is not as tenuous as Russia. And there has been some collusion that's probable between China and the United States when it comes to their holding of our treasuries and China getting sweetheart deals of acknowledging that they can accumulate gold for all of these years at discounted prices because they're playing along with Washington and keeping up this facade. And if that's an operating assumption, it's not too far of a stretch to go one step further and to say, well, you know, the people who are managing this con game in the United States, the policymakers and the Treasury and the Fed and all that, probably have a pretty decent awareness that rather than waiting to that very last ounce that you were speaking of, they might actually do a banking holiday and a currency reset. And these are the kind of things that, you know, the IMF has speculated on. The Bank of International Settlements has talked about in white papers, or people within the institution talking to the media and letting comments like that slip, or Jim Rickards' work and, you know, both of his books, he's hinted that that's one of the kind of scenarios that the powers that be think about. So, you know, I don't know if we'll see the whole ball of wax implode because, you know, this derivatives mountain scares the heck out of the powers that be. So maybe we'll see just a bank holiday scenario. They close down the COMEX cash shuttle one day, and then 2 days later, Chinese and Russians and the United States are working together at $5,000 gold. And who knows, you know, maybe that's the scenario that'll happen.
But I'm looking at every day, China brings in 4.02 tons every single day, no matter what. Okay, every day that gold goes into Shanghai.
Yeah, it's amazing.
So in other words, they're going to ask, they want it. And when I start seeing the supplies coming from England dissipate, then there's only one other source that I know of, and that's over in New York, both COMEX and the Federal Reserve Bank of New York. And when that gold's gone, God help us all.
And to put that number in perspective, about 5 tons a day, that's what it took the Fed supposedly a year to scrounge up that much gold for the Bundesbank.
5 tons, yes. For the whole, 5. That was... Yeah, and I doubt very much if this year the Bundesbank will get any tons back.
And to add to the Chinese demand, Harvey, we now have Modi being elected in India, and already what we've been anticipating for quite a while, the gold restrictions have begun to be eased. I believe it was 20 of the merchants are now that had been banned are again allowed to import and sell gold. So you're going to see Indian, at least official demand, pick up substantially throughout the second half of 2014 and into the wedding season as well.
Correct. The Modi situation is fascinating because the Americans kind of asked the Indians to kind of put this tax on to slow down the Indians' purchase of gold, which is, and that's ingrained in them for years. I mean, before even China started, India was importing close to 1,000 tons a year. This is way back in 1998. I mean, they were the dominant importers of gold. And now, what actually happened is, of course, smuggling was so huge now. Pakistan, and they went to Turkey. So Turkey was in Istanbul was a major center. So they would just load, and every plane load had one person taking in what was it, 6 ounces, 8 ounces of gold with them. They realized every citizen was bringing in gold. They're smuggling. So of course, you know, a lot of these excess of rupees were going to buy gold. So they weren't getting anywhere. So they realized they got to stop this. Now you can imagine the demand that's going to come. So not only are you going to have China's demand, which is running at probably 100% of global supply, which is 2,200 tons. When I use supply, I take out Russia and China as a supplier, because not 1 ounce ever leaves them. No one's ever seen a Chinese kilobar, by the way. So all of our gold stays there. So really, we're talking about 2,200 tons of supply from the globe, and that is roughly how much gold is going into China. You start putting 1,000 tons of gold coming in from to India, and then probably maybe 400 or 500 tons into Russia, and then Iran's going to do it, and Turkey. Turkey is, of course, is the conduit for gold purchase for the Middle East, and that's where they do all their purchases through Istanbul. So the demand, I can see the demand going into about maybe 6,000 tons, of which the banking system just cannot. The forwards are going to have to be calling in their loans, and the game's over. I mean, where are they going to get their gold? That's the crisis that they're coming up with. And China realizes the game. They're not stupid. They understood what's going on, and they're happily taking in their gold, and they're very slow and methodical about it. They have a set amount they're taking in constantly, and they're doing it. And I can see a crisis. Actually, that was one of the questions that was asked of me by the CFTC commissioner. He says, do I think a COMEX can default? And I just told him, I says, I can see, this is in 2010, before even China was doing anything. And I said, I could see China taking in lots of gold and just bankrupting the system. And sure enough, this is what we're seeing now. So I'd be very careful on this. I really think it's going to be a physical default first before a paper default. Okay, so that's where we kind of, I'm very concerned of a physical default, which will then precipitate a paper default on top of that. After
yeah, well, probably almost instantaneously. If a physical default becomes public knowledge, then boom, there goes the paper.
You got it. Yeah, that's where I don't think you're going to see a paper default before a physical. Okay, that's probably where you and I do differ on it. But anyway, but it doesn't matter. It's
like
certainly
the tail wagging the dog.
That's correct.
Either way, it's going to have drastic implications on the landscape for those in North America or the U.S. in particular.
Oh yeah, and it'll be this year. I cannot for the life of me see it lasting longer than the end of this year. So I think you're going to see a default somewhere around this time period, maybe in June. So, and that's why you're seeing this such narrow range in the gold that's trading. It's just the bankers are pulling their hair out. They cannot let gold go beyond 13. Why? Their derivatives blow up. So they're keeping it down. Meanwhile, the other side are very happy to take whatever physical metal you can. And China and the East are more than happy loading up the boats and moving it eastward. And, and then all of a sudden the West is going to wake up and say, what on earth did we do? So,
yep, and John, the last week we were talking with Dave Kranzler about the whole odd trading in the U.S. bond market on the long end and whatnot, and what's going on with the Belgian purchases, and it's interrelated with all of these things most likely because given the paranoia about the interest rate swaps in particular and the derivative bloat complex we have worldwide. It could very well be the case that the powers that be are making a very concerted effort right now, the last 60 days, to push the bond market down and manipulate the bond market further with hidden purchases so as to take the pressure off of any fast moves that could upset the interest rate swap derivatives. And gold in part is related to that as well too. You know, just buying time, stalling, kicking the can down the road.
And this is just a theory, but I think that the ultimate motive or the reason for the money laundering through Belgium, I guess my take is a little bit different than what Kranzler and Paul Craig Roberts are purporting. I don't see it likely as just a continuation of QE. I think it was something that out of necessity they scrambled and had to do because Russia started liquidating their treasury bonds with the whole crisis in Ukraine. The numbers are pretty similar to Russia's decrease in treasury bonds. So
yeah, they did speculate that that was part of the possible rationale. I mean, they did mention that. So it's all theory. Obviously, we're on the outside looking in, so we don't know for sure. But the numbers of the purchases, the dollar value is in excess of the tapering that's happened thus far. And you know, that says a lot right there.
Regardless of the ultimate reason that they're forced to do it, there's no other buyer.
100% correct. What actually happened, and I'm pretty sure this is the purchases of the Belgian bonds were through swaps, and Belgium is, of course, the EU center, and it was done through Euroclear. And what the United States in 2011 engineered huge swaps with Europe, where euros goes over to, so United States dollars goes over to Frankfurt, and Frankfurt brings euros over here. The dollars that's over in Europe would now, they utilize these to purchase these bonds, and they hit it. First it was the Caribbean, and now it's about $300 billion, which is probably very close to 100% of the GDP of Belgium. So they're holding it off balance sheet, and that's why. So as long as you hold it off balance sheet, you don't. The United States doesn't have to put it on there. So their deficit is hidden. So that's what they're trying to do, is hide their deficit. And of course, they don't want to show, their debt to GDP is certainly rising to 120, 130. That would scare the living daylights out of everyone. So that's what they're trying to hide. Okay, but that's what I believe, Dave, is similar to what I'm thinking. I've been saying all along it's done through swaps, and I think a few others as well. But I'm pretty sure that's what happened. Okay, and of course they don't want to tell what they're doing. They're secretive, and so they're hiding the true mess that they're in. And so, in other words, is there tapering? Absolutely not. There's no way. This business of QE is going to continue ad infinitum until the game is over. There's no such a thing as tapering. They just had to show the world that they were to kind of help the dollar, because the dollar was starting to implode. Below, it was 80, and then it was going into the low 79s. Anything below 79, of course, that would be a catastrophe for them, and they certainly didn't want that. So this move was basically to try to get the dollar up a bit. So that's my take on the Belgian situation.
Yeah, all the signs definitely pointing to the possibilities of big moves in the market and throughout the summer. It might not be a long, boring summer, guys.
It will definitely be not very boring. I'm watching this, like I watch the GLD like a clock. I watch the export side from the U.S. because that's going to be the key figures for me as to when the bombshell is going to hit. So that's my job in watching this for you guys.
Well, keep watching it for us, Harvey. We appreciate it. We know all the readers and listeners appreciate your efforts and keeping close eyes on that. So.
And as a final subject, we should probably just toss out really quickly a note about how BaFin had come out this week talking about the issue of forex manipulation. And interestingly enough, they didn't say a peep about precious metals manipulation. And a representative for BaFin was talking about how their investigation can go on until about 2018 before they can fully wrap things up. So there was a lot of speculation earlier in the year about how BaFin was going to be making waves and peeling back the carpet and looking underneath the carpet to see what's going on. But when it comes to precious metals, I think Germany at this point has kind of tucked its tail between its legs, realizing that they can't get the gold that they wish to have repatriated because it just isn't available in volume. And at this point, they don't want to contribute to seeing the apple cart turned over and prices shooting higher with revelations about manipulation. So I don't think it's I don't think it's very surprising that Boffin spoke absolutely nothing about precious metals manipulation, yet addressed the Forex issue, and in fact described it as being worse than LIBOR. The story needs to continue to be tracked, but it was interesting that they came out this week. So just wanted to toss that out there because we had reported earlier extensively about what Boffin was doing.
All right, so I think we'll wrap up the show there this week. So both Harvey and Eric looking for potential explosives in the COMEX this summer, with COMEX inventories running low, with Harvey stating the bullion banking cartel is nearly down to their last ounce, and Eric even agreeing that we could see some big moves this summer. So we'll see. And again, Harvey, keep up the great work, keeping your eye on it and keeping us updated with what they're doing behind the scenes and in their swap transactions and on paper.
Well, thank you very much, and it was a pleasure being with you guys today.
All right, so for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.